Well, today we're doing things a little bit differently. We're reviewing 3 value funds and comparing them and their performance. The first being the Allan Gray Equity Fund. Now it's managed by Ian Liddle, Duncan Artus, Andrew Lapping and Simon Raubernheimer. Looking at the Investec Value Fund, manager there John Biccard, and the Nedgroup Investment Value Fund, Dave Foord. Of course, a famous name in the asset management space. Talk to us about why we're choosing these 3 value funds.
I think first and foremost, these are 3 darlings of the market, 3 value brands. These are names and faces that everyone knows. So it's very important to try and understand, is there performance behind the hype? And also, at the end of the day, they've put themselves out there as deep value managers. And what does that actually mean?
Yeah, but I mean, let's look at some of these results. Look at the graph on your screen at the moment, and you'll see the actual returns for these 3 managers over time. This graph over here comes courtesy of Morningstar, the data services at Morningstar. And if you look at it, this is now since 1998. You see the returns for the 3 different managers and how they've actually performed over time. Now, you can see Allan Gray Equity having done fantastically well. Investec Value, obviously following that. And then with the Nedgroup Investment Value, which is Dave Foord's fund, being just below the Investec Value Fund. And as a matter of fact, if we have to show you what the returns look like for those 3 funds, you can actually see what they look like. They handsomely beat the all-share index. Sorry, Roland. There seems to be skill here. Long term, and you can see the returns quite similar, but obviously a slight difference between the Nedgroup Value Fund and the Allan Gray Equity Fund. Look at from a standard deviation perspective, reduction in risk relative to what the all-share index obviously provides. I mean, again, Roland, let's just get your feeling on this here. Long term, there seems to be there's been a value trend here. Value seems to have added incremental value long term.
Absolutely. I think value investing is very important and valuable, but you don't necessarily have to have a value fund manager to do that. You can buy a value index. And a lot of value indices have outperformed the market as well. But certainly one would have to drill down into the stock picking ability of these managers and the market timing. And there's vast differences between those performances. But Phil, you speak to a lot of these managers because you put money with them. And I always wonder, everyone is a value investor. So when somebody says to me, I'm special because I buy shares that are cheap and sell them when they're expensive, don't you sort of get bored with that? Or is there something else that you need from these managers to excite you?
I think there needs to be a health warning on that as well, because just because it says value in the name doesn't mean you're going to get value. If you look at the performance of these 3 managers over the last year, their performance has been extremely different. If you took John Biccard's performance from the start of 2000, he would have significantly outperformed Allan Gray over multiple periods. Allan Gray did very badly in 2003, 2004, when everyone was selling out of their funds, which was the right time to buy them, of course. And at the end of the day, the exposures these funds have got at the moment, despite them being deep value investors, are extremely different. The industrial and the retailer exposure in Foord is significantly higher than that in the other managers. The resource exposure, particularly with John Biccard right now, he's been hurt because he's been extremely exposed to gold, to platinum, shares that he would be buying into the weakness right now. And you've seen Investec Value since August last year underperform the all-share index and its competitors by about 20%. However, though, the last time he underperformed like that, he did extremely well over the next few years. And this is the question we've got to ask our managers.
I mean, so basically you're saying not all value funds are created equal. You need to dig deep into kind of underlying philosophy, the type of stocks that they hold, the type of exposure in terms of sectors. How does this tie into the financial personality test, and can we kind of draw parallels?
Again, what we need to understand is the type of portfolio we put together for clients need to suit their style. So someone who has a low tolerance for their manager underperforming the market, like we said Roland would be extremely happy right now if he had one of those fund managers in his portfolio. So I would manage a passively driven portfolio for Roland. So I don't only look at active managers in clients' portfolios. We will use passive for the right clients. We will use protection where it's applicable. But for clients that have a high composure but are also have a high delegation and are happy to sit through the tougher times, you would want some exposure. But what you would also need to be cautious of is overexposing to one manager, assuming you're buying value. Roland's point is extremely important, that the value factors are not consistent with these managers, and you need to be strongly aware of what you are buying when you buy into these managers.
As a matter of fact, let's look at that short-term performance, because I mean it shows a massive disparity. I mean, you don't see it over the long-term chart, but there certainly is a disparity over the short term. Just look at the graph that you see on your screen right now, and you see those three managers, and you see how they've performed. Right at the top end, that's Dave Foord's Nedgroup Investment Value Fund. Then you've got the Allan Gray Equity Fund. You see the returns for that over there. And then right at the bottom is John Biccard's Investec Value Fund. Certainly
is that where the resources are all?
Yeah, absolutely. Sitting? And I mean, certainly that's been a fairly tough environment. By the way, the shaded area that you're seeing running through the graph over there is obviously the all-share index. Just to put it to you in number terms, just look at those. And you can see what those returns look like. Look at the Investec value there at minus 1.8. I mean, again, for me, this comes down to investor behavior. You know, I always say to investors, do you believe in the philosophy? Do you believe in the process? Do you believe in the manager? Because if those things are intact, then you're going to take the ups with the downs. Because there's no question that John Biccard's going to do very, very well in the future. He's a star fund manager. But can you take the volatility? Is that something that kind of...
Can you stomach the volatility and have a longer term perspective? So, of course, that is always important. But what about this question that you've raised here, Roland, in terms of value investing? I mean, isn't everyone a value investor? We all want to buy something cheaper and then see it run up.
Well, I like to say that the fund managers have all got the same piano keys in front of them, but they all play different tunes. So don't assume just because their stocks look similar, because if you look broadly at the top 10 holdings, they look quite similar in some respects, but the performance can be extremely different. And value by nature tends to do quite well when markets are falling and tends to do poorly when markets go up. And by investing in value companies, those are typically companies that could fall further. So you need to demand a higher return if you're going to take that value risk, because those companies typically are in distress, and you're looking through the cycle and you're saying things are going to get better.
30 seconds, 15 seconds, 15 seconds, closing comments.
I think one must start looking, especially if the world is recovering, for having value as a base kind of allocation, but also something that is more growth oriented.
Listen, I think behavior, I think behavior, you know, 15 seconds, I've never done anything in 15 seconds in my whole entire life. Behavior is important, but remember your objectives as well.